Welcome to Optimal Insights, your weekly source for real-time rate data and expert capital markets commentary, brought to you by Optimal Blue. Let's dive in and help you maximize your profitability this week.
Welcome to Optimal Insights, your weekly source for timely market analysis and expert commentary from Optimal Blue. I'm your host, Jim Glennon, Vice President of Hedging and Trading Client Services at Optimal Blue. Our clients and industry partners have long relied on Optimal Blue for trusted insights and commentary, and these podcasts are an evolution of our commitment to keeping the industry informed. Let's dive into today's episode. Welcome, everybody. Hope your week's been good. We're recording this on Friday, but we'll be releasing it Monday when we will be at our conference, our Optimal Blue Summit that we've been talking about on this podcast and everywhere for the last few months. So hope to see a lot of you there. We will also do a bonus episode. Look out for that kind of midweek from the actual venue. We're going to have a studio set up there to do a podcast. So excited about that. But for today, we're going to talk with Ben and Kevin. We'll talk to Ben here in a sec about what's going on in the economy recently. What should we be looking out for next week while we're all at the conference? And what are some other current events going on? And then we'll have Kevin on a little bit later. We'll talk a little bit about some of the AI news that's been out there. I think we all saw the headlines about DeepSeek. And there's been some subsequent discussions about NVIDIA and other, AI platforms and what the DeepSeek news means for that, and just kind of highlighting some things going on in the broader world of AI. First, maybe a little bit of data. As you know, rates are stubbornly high. We're right about 6 7/8 right now in the conventional 30-year. If you follow the OBMMI, which again is based on about 40% of locks that are happening in the industry. Volume still stagnant, but pretty healthy. We're still at like 80% of pre-COVID levels, which is pretty healthy. 2019 was a good year for mortgages, if you recall, even before COVID. So 80% is pretty good. And we're like 150% over this time last month, but obviously that was around the holidays. So does not mean a ton. Before we meet up with Ben and talk through some econ info, I just wanted to acknowledge the unspeakable tragic plane accident that occurred earlier this week in Washington. Just a horrible situation there. Obviously, our hearts and our prayers go out to those who lost their lives and everyone affected, family and friends of that accident. And it's obviously hard to make a transition from talking about this into our next segment, but we'll certainly try. All right, let's welcome Ben. Hey, Ben, good to see you. Appreciate you being here. A lot to talk about. Economy-wise, that we've had some numbers come out this week. We've also had the FOMC meeting earlier this week, and then we've got the always important unemployment report next week. Let's start with the Fed meeting. What are your thoughts on that?
Yeah, pretty much as expected. No major surprises. Kind of an initial market reaction to some removal in the Fed's statement regarding the phrase "progress on inflation." That phrase was eliminated, and so I think markets were like that kind of a little bit concerning, but it turns out Powell did clarify that it wasn't supposed to mean anything specifically, really just you can't say progress on inflation forever. Obviously it's kind of a term that is time sensitive, so I think it makes sense to remove it, and I don't think there was really anything new in terms of just kind of still running, about 1% above the Fed's inflation target, not necessarily getting any worse at this point, but, progress has stalled. And I think everyone's aware of that. Powell did say they don't need to see the labor market weaken to reach their inflation targets. So that's definitely a good sign that, we might not need to see the weak job market that we thought we might be heading into early last fall. And it could just be, hopefully inflation comes in line with these slightly elevated rates, kind of dragging that inflation down here in the coming months or maybe the coming year.
Yeah, it was interesting. It used to be any slight change in language was highly scrutinized and could potentially move the market, especially in a sensitive spot like we're in. And they did remove that very important line. And even before Powell made his clarifying remarks in the press conference, the market didn't react heavily. So I think that was good to see. Almost maybe like the market feels like we're at a natural ceiling in terms of rates, mortgage rates. And then it was also, like you said, good to hear that the Fed acknowledges that they have their foot on the brake pedal right now. So they just need to see inflation probably a bit better for a longer period of time versus having to see something go south like jobs, where normally that's when they would start stimulating the economy. But they're so hard on the brakes right now that it wouldn't be, there's no need to put your foot on the gas pedal. They're just willing to take their foot off the brake more if inflation continues to remain tempered, even if jobs are still stellar, which would be just kind of this perfect landing that we've talked about, this soft, perfect landing, right?
Yeah, they kind of know it. I think they expect that things will cool on the inflation front over, and it might not happen in the next few months, but it certainly will, in the coming years at some point. And I think they know they're in a good enough spot now. Like you said, like we're at least under 3% inflation. They're on the right track. And so, yeah, they definitely don't want to risk reaccelerating inflation by getting too aggressive in cutting. Seem to be in a good spot. And I think, heading into it, I think that the official tone was like, wait and see. And it seems like Fed officials weren't really willing to lay too much out there in terms of what they thought might happen, et cetera. And that's kind of what we got in this meeting is just, we're going to wait and see what happens. We're not in a rush to cut. We're also not really anywhere near a hike. And let's just see some more data. And I think that's what the market expected. And that's kind of what we got, and pretty muted reactions in every sense.
Right. And still no direct reaction to some of the rhetoric coming out of the White House, which I think is appropriate, just keeping that separation, right? And not taking into consideration even some of the policies that are starting to come out in executive orders, whether it be mass deportations or a lot of tariff talk, which we'll get to here in a sec, because we've had some very recent news on that. So I think that's healthy as well.
Right.
All right. So this week we had a couple pretty big numbers that come out. We had GDP earlier in the week, and then we had PCE just this morning. The former was fine. It was a little bit low. And then PCE today pretty much came in on the screws, right? Any other tidbits out of those releases?
I think you pretty much nailed it. GDP came in at 2.3% versus 2.6% expected. I don't think it's uncommon to miss by a few tenths of a percent, unlike a lot of the inflation metrics you miss or beat by several tenths of a percent. The market's going to freak out. That doesn't really happen with GDP. But yeah, we were 3.1% in Q3 of 2024. So definitely down a bit from that pace. Not totally unexpected. The PC inflation component you mentioned was at 2.5% for the entirety of quarter four. But then the December portion that we just got this morning came out at 2.6% year over year. So a little bit hotter, and 0.3% month over month. The core number there was actually at 2.8% year over year. So still definitely elevated, but again, not at anywhere nearly as concerning levels as we were at too long ago. And all those numbers were basically, as you said, right on the screws. No major surprises, nothing that's going to change any of the current narratives out there regarding inflation. So kind of another PCE report that turned out to be a market non-event, which often seems to be the case with CPI just getting released a couple weeks prior generally, and then other releases such as PPI and even the GDP report we just talked about, some of that giving some insight into what this morning's PCE release is going to be. A lot of traders, I think, are pretty well able to triangulate what the number is going to look like.
Right. It's kind of old news at that point, right? Because we've been able to, even though it is the preferred measure for the Fed, it's old news. It kind of, like you said, you triangulate several of those other inflation numbers and then some components of GDP, and you can get there, or you can see if it's going to be out of line. Good. So speaking of inflation and the Fed, there's been some breaking news this Friday afternoon. Why don't you lead us on that tariff news?
Yeah. So it sounds like what we've been hearing for several weeks, if not months at this point. The Trump White House is going to levy tariffs on Canada and Mexico at 25% and 10% on China. I think with Canada and Mexico, it's coming from a place of Trump sees some border issues and security, and almost as a response to what he sees as potential inaction on their part. So it looks like those are actually going to go into effect on Saturday morning. It's basically certain that we're going to see a retaliation from probably all of those parties. That's generally how these things work. So we'll have to see how the dust settles early next week. I'm sure markets will react further. We were kind of up on the day on stocks, and I know they lost a lot of their gains, and I think bonds are selling off a bit as I think a little more inflation is getting priced in, and perhaps the markets are kind of realizing, okay, it's not just talk. This is going to come to be. It's possible we get a quick resolution like we saw this last weekend with the kind of the Colombia, I think was refusing planes of deported immigrants from the US, and that created kind of a spat where there were some threatened tariffs, and then an agreement was reached, and it all kind of came off the board. So we'll see if that happens, if it could just become a kind of a negotiating tactic and what the end result might be. But certainly kind of entering some uncertainty here. I'll also point out, like, these tariffs are certainly inflationary, but could also be an impact on growth in the longer term. And we could actually see a bit of a slowdown economically because of it. That could lead to lower rates. No guarantees, but as always with lower rates, you got to be a little bit careful what you wish for and how you're getting those lower rates. Like, I don't think anyone wants to see a job market get leveled and also see lower rates, which we often root for in the mortgage industry, because that could have a totally big separate impact as well.
A good effect. Yeah. We're always in that age old conundrum in the mortgage industry where we root for bad jobs numbers,
right,
to lower rates, even though we don't realistically want people to lose their jobs. It's
right.
but it is part of the natural cycle, and it is hard to tell what part of the cycle we're in now, because there's still so many waves that came from all the way back to the pandemic and even back to the great financial crisis. If you look at the Fed intervention piece,
Right.
But anyway, that's a tangent. Yeah. So these tariffs go into effect tomorrow. So by the time you hear this podcast, it's hard to know what the status will be. Will it be that the administration is just looking to get Canada and Mexico to the table to get them to agree to some things that are already in discussions? Or is this something that could have a longer term resolution or longer term ramifications? Or do these tariffs actually go into place and goods that come over the border actually start getting taxed at a quarter of their wholesale price, which is very significant.
Yeah.
And will have long reaching effects on our economy.
Right. Yeah. I think that next week we'll probably get some more clarity of whether there's going to be a quick resolution. And even setting tariff and other policy news aside, we do have Fed speakers, job openings on Tuesday, and then a non-farm payrolls report next Friday. So it seems like there's a plethora of opportunities for potential market volatility to show up next week, and we'll have to see how it all plays out.
Right. So Fed speak on the heels of some of the drama this week. And then, the unemployment report, always highly watched, and remember, keep an eye on the components of that. The last couple of years, it's hospitality, healthcare, construction, and government have made up a vast majority of new jobs, whereas a lot of sectors, a lot of what you might traditionally call white collar sectors, tech, banking, finance, this sort of thing has been pretty depressed for the past year or so. So it'll be interesting to see if those areas that have been hot continue to stay hot, or if we actually start to see those numbers drop into the hundreds or even the double digits of growth.
Right. I think the expectation is going to be right around 175,000 again. But dig deeper into those other components. The composition, what are wages doing? What is the unemployment rate doing? And some of those often will tell a little bit different stories. So you kind of got to parse through sometimes conflicting evidence to get some insights.
That's right. All right. Good stuff, Ben. Thank you as always. Appreciate the time.
You bet.
Okay. Welcome, Kevin Foley. How are you, sir?
Doing pretty well. Excited to be here. Excited for the conference.
Right. We're all getting ready for the conference. It's late on a Friday. We're getting last things tied up, but we're really getting into conference mode, I think. But Still keeping an eye on the news. And lately there's been some kind of earth-shaking news as it relates to AI, right? I mean, AI has been a huge thing in the news for the past year or so anyway, but then this DeepSeek thing comes out, and I still don't fully understand it. I'm not a big reader, so I'm hoping you've read more than I have. What are your thoughts on some of the recent news and some of the revelations that have come since then?
Yeah, no, it's a great question, great topic, and I figured in the same vein that we try and help originators become more educated consumers of economic news, it might be worthwhile to do a segment like this where we can help originators become more educated consumers of technology news, because this is some pretty big technology news that's dropped in the last couple of weeks. So DeepSeek, what is it? Quick recap. DeepSeek is, a company in China, and they created a model called DeepSeek, and they rolled that out. That was, in the last couple of weeks. And there are a few things that were very interesting about this. So number one was that it was on par or better than some of the American-based models, such as ChatGPT, that many of us are familiar with. And then number two was that it, from a processing power perspective, it uses less than 5% of the energy that a model like ChatGPT uses, and it can run on significantly less sophisticated chips, which is important for the infrastructure of these models. So that energy savings translates directly into cost savings. And so if you're to go look and use the DeepSeek API, it's significantly cheaper than the American models that are out there, again, by the order of like 95% cheaper, which is huge.
Yeah, it's almost like, the math doesn't math, right? And that's when some of the debate has been the last week or so, because if you go back a couple of weeks and you had the announcement from some of the big AI players in the US that they're going to invest $500 billion in AI. And then you have NVIDIA, the top player, at least market cap wise in AI, worth trillions of dollars. And then DeepSeek comes out and says, we did it for 6 million.
And so that 6 million number, that seems a little more debatable, but the actual efficiency gains that the model is seeing do seem to be playing out, certainly based on everything that I've read, and try and follow some of the folks who are on top of this research and more reliable. But yeah, so it's sort of, I think to your point, called into question a lot of this investment from the American, big American companies. Do we really need this substantial investment in chips and AI technology in order to get to where we need to go? Or is it possible to do things more efficiently? So it's been a very interesting, sort of dynamic. The Microsoft CEO, Satya Nadella, he posted recently about the Jevons paradox, which is this idea that as technology becomes more efficient, it actually increases the demand for that technology. So, instead of potentially having all of this investment dollars that might be wasted on chips and whatnot, if they're not really needed, if you can actually be more efficient, the CEO of Microsoft is saying, well, this might actually spur even more investment into the underlying hardware and the technology, because the efficiency gains make it a lot cheaper for everybody.
What are some of the controversies, though, that have come out since some of the news last week, and then some of these new revelations? I've read odds and ends, but what do you think is the most, I don't know, maybe has the most legs under it?
Great question. So there is, if you play around with DeepSeek, which, some folks that work for the US government, I know it's been restricted because it's based in China and all these things. But if you play around with it, sometimes DeepSeek actually thinks that it's OpenAI's ChatGPT. And so it sort of, calls into question how much of the training for DeepSeek was done directly against ChatGPT. And actually, OpenAI came out and said that DeepSeek has violated its terms of service by the way that it may have been training directly against the model. And so it kind of brings up this interesting question, because one could argue as well for OpenAI, like, for instance, if you were to ask ChatGPT, draw me a picture of a cross between a man and a sponge, it's going to generate a picture that looks very much like a well-known cartoon character who is yellow and wears square pants. That's just, the material that it trained on. And so, who owns that intellectual property? There are all these sort of fascinating questions that are coming out of that. And I think there are sort of two blind spots that led to this coming out. So two blind spots by the American companies such as, OpenAI and other folks who've been very, hyper focused on onshore. The first is that, ever since ChatGPT was rolled out, there's been a hyper focus on something called AGI or ASI, which is artificial general intelligence or artificial superintelligence. So everyone saw how powerful ChatGPT was, and they said, well, wouldn't it be amazing if we just got it to the next level and, we started finding cures for cancer and solving math problems that humans have never solved before? Well, that focus has sort of taken precedence over trying to make what we have in terms of artificial intelligence more efficient. And that sort of left an opening, I think, for other players like DeepSeek to come in there and tackle that problem. The second kind of relates back to the whole point about training against, OpenAI's model, which is that the US has heavily restricted the flow of advanced chips needed to train these models to China. But we haven't focused on, providing access, or we haven't focused as much on, access to these models directly for training purposes. We sort of left the back door open a little bit by, all you need is a $20 a month subscription, to ChatGPT to, ask it lots of questions. And, not saying that that's necessarily what they did, but it seems like that's, something along those lines may have happened.
Right. So that's the going theory right now, I suppose, is that this maybe you can put together a model much cheaper than what's been built so far if it's taught or it learns from the existing models. And also you have some access to those very high performance chips that run AI.
Exactly. So I got some hot takes, Jim, on what I think might happen. These are my own opinions. I speak for nobody else. I think kind of analyzing all the information that's out there and looking forward. Hot take number one: AI will become cheaper in 2025. I feel like that's already starting to get a little bit baked in. We have a model that's again running on 5% of the the overall efficiency of some of the major American models, and they've open sourced that, which means that they show you exactly how they did it. It's only a matter of time in my mind until some of that stuff starts getting adopted by the major American models. So that's hot take number one. Number two,
makes sense.
AI models, I think, will proliferate. It'll become much easier for any major company who hasn't built their own AI model, but maybe they have like a big tech presence, for them to actually go and create their own models. Because again, now that DeepSeek is open source, there's sort of a blueprint for how to do that. So if you don't want to go through another model, you could create your own, and there's sort of a roadmap for how to do that. So I know that like Alibaba and Tencent have kind of recently launched new models, and I expect that there's probably going to be more of that sort of thing, as opposed to using a model that's already out there. Big firms, who knows, maybe Amazon might just go in and end up creating their own.
It totally makes sense. Everything in technology tends to go that way, is that the front runners put most of the money into R&D, or any product really. And then you get sort of not so good carbon copies of that, but good enough and much cheaper. The fact that DeepSeek is much more efficient is a little curious and very interesting, because that's, where did they get that from? But then from there, it really should just proliferate, right? Where the mom and pop shop can build their own AI model at some point, and then the AI models should make themselves more efficient over time. I would think you could tell an AI model, make yourself more efficient, go into this code, strip it down, make it faster, make it smarter, right?
Who knows? Maybe that's what happened. We weren't in the room, I suppose. So, it could be something like that.
And they have to have, NVIDIA, Microsoft have to have saw this coming. They've been building technology for many years. They have to have seen this coming. Maybe not the exact way that it was going to manifest itself, but you would think they have money and resources geared towards protecting some of that investment. But again, who knows?
Well, so piggybacking off of that, this is my final hot take. This is the last one. But number three is I believe that the most advanced AI models will become harder and harder to access. So, as I sort of mentioned, where OpenAI sort of left the back door open for other models to be able to train against it. I feel like there's going to be this level of AI that exists today. It's all the stuff that's out there, publicly, that folks will be able to access and will be able to train against. But as it gets incrementally better from where it is now, I feel like those are the models. Those new versions are going to be the ones that are going to be very tightly locked down, because if you open up access to those for everybody, or for large audience, then you kind of risk losing that edge and that intellectual property. So I feel like there's going to be a little bit of a segmentation between the haves and the have-nots in terms of the latest AI innovation.
All right, so they're just going to protect their IP better than what's been done so far, and maybe walk back a little bit of the openness that was supposed to be these AI models.
Yep. Well, we'll see. They're just hot takes. My hot takes.
Just Kevin's hot takes. They do not reflect.
They bat about 50-50. So, it could go one way or the other.
500 is good. Good stuff, Kevin. Appreciate the insight as always. We'll be watching, more news about this, and just generally, we've got our own AI at Optimal Blue. We'll be, learning more about that come next week with some big announcements.
A timely discussion, if you will.
Yes. All right. Thanks again, Kevin. Have a good weekend. Travel safe.
Awesome. You too, Jim. Thanks.
All right, let's wrap this thing up. Thank you very much, Ben. Thank you, Kevin, for the information, the wisdom, and the conversation. Hope to see you all in San Diego next week. That's it for today. Join us next week for another episode of Optimal Insights, where we'll continue to provide you with the latest market analysis and insights to help you stay ahead. Don't forget to follow us on LinkedIn for more updates and to access our latest video episodes. You can also find each episode on all major podcast platforms. Thank you for tuning in to Optimal Insights.